What's up everybody, Genix Dividend Investor here. In this video I'm going to explain how and why dividend investing works, as well as how and why it can fail. And stick with me, because later in the episode I'll show you a clip that just aired from a respected major financial news network that essentially bashed my social media and investing style. Now, a key reason I'm doing this video is because I recently was talking to someone who said they just saw a video where a YouTuber was claiming that dividend investing was a bad long-term thing, especially going into retirement. I did a quick search on YouTube and found a ton of video titles saying similar things like, why dividend investing doesn't work, dividends suck, here's why, dividends are bad, dividends are garbage, proof that dividend investing doesn't work, why dividend investing is bad for passive income, and a bunch of others. The irony of all that is I was able to retire from my 9-to-5 jobs once my passive dividend income was more than my family's expenses, so I fundamentally disagree with the dividend haters out there. My dividends allowed me to quit working a little over 5 years ago when I was still in my 40s, when our dividends started paying our mortgage, our healthcare, our groceries, etc. So I'm highly confident when I say that dividend investing can work, as I've been doing it for decades, and I've been investing in the stock market for over 30 years now. I don't say that to brag, but instead simply to tell you what I've experienced. In fact, each year that goes by only makes me happier that I decided to become an investor who focuses on quality dividend stocks, especially now that I'm retired. I plan to be the first person in my family line who starts true generational wealth for my heirs, in a manner that I believe will be simple for them to follow. Note, I also believe it can be smart to invest in non-dividend stocks, though in retirement I've opted only for companies that pay dividends. And to make sure we're all on the same page, I'll start by briefly explaining how dividend investing works, but feel free to use the timestamps to jump around. Okay, dividend investing is a strategy where you buy stock of companies that regularly pay part of their profits to shareholders in the form of cash payments called dividends. Usually you get paid quarterly, but some companies pay monthly. That means you get cash just for holding dividend stocks in your brokerage account, even though you didn't have to sell anything to get that money. Many investors choose to reinvest their cash dividends to buy more stock, which enables a compounding snowball effect over time, where things tend to grow faster and faster. All they do is turn on a reinvestment flag in their brokerage account, and then their dividends buy more shares of themselves automatically, which is probably part of the reason why there's a classic saying that the best portfolios are from dead people, because those accounts can just keep compounding over time. It's kind of like a stronger version of interest getting interest, where the more you get, the faster you can grow. Plus, good stocks tend to go up in price at a much faster rate than inflation or bank interest, which is another reason why equities are often way better than holding all your money as cash in the bank. Anyway, a cool thing about investing in dividend stocks is that you're effectively buying income rather than being limited to the classic buy low, sell high thing. And that's why in the thumbnail for this video, I showed someone harvesting cash from something they planted. Dividend investing can give you steady income without cutting down the tree that produces it, meaning you don't have to sell your stock. You collect the fruit, the dividends, while the tree, your stock, stays strong and hopefully keeps growing. Over time, your cash garden, aka your portfolio, expands naturally as your investments grow, and even more so when you reinvest your spare cash to create new income streams. Stock appreciation makes your trees grow taller, and dividend increases mean each one produces more fruit for you to enjoy. When you reinvest those dividends, it's like planting new trees, adding even more to your future harvest. Before long, your portfolio turns into an orchard that keeps producing more income every year. Of course, some companies can go bankrupt, just like parts of an orchard can get damaged. And there's no guarantee that every company will keep paying or growing its dividends, just like there's no guarantee that every tree will keep producing fruit or that any investment will keep doing well. But if your orchard has many kinds of fruit, meaning a well-diversified portfolio of quality dividend stocks across different industries, then you probably have good odds that your income will keep growing faster than inflation over time. So quality dividend investing isn't a get-rich-quick thing, but it has been a steady get-rich-slow journey for me, and I've seen that the longer you hold quality dividend stocks, the faster your passive income grows and the larger your overall portfolio becomes. Another cool thing about dividends is that they pay you a fixed amount based on how many shares you own, not on what the stock's price is. For example, let's use one of the dividend tickers I own, Coca-Cola, to show what I mean. Google tells me it costs $69.71 a share, and it says its dividend yield is 2.93%. That means if you invested $100 into Coke right now, then over the next 12 months it should pay you $2.93, spread out over 4 quarterly payments, assuming the company didn't raise or lower their dividend. Let's take a look at some of Coke's dividend metrics on Seeking Alpha, an investing website I'm an affiliate of. Here we again see that Coke's current dividend yield is at 2.93%, and that percentage is calculated by taking its annual dividend it pays out per share, which it says is $2.04, and dividing that by its current share price, which was $69.71. So $2.04 divided by $69.71 is about 2.93%. And as an example, if Coke's price shot up to $90 a share, then its dividend yield would fall because $2.04 per share divided by 90 equals 2.27%. It's just math that as price goes up, current yield goes down, and as price falls, yield goes up. That means if you invested $100 into Coke after its stock price shot up, you'd get a lower yield on that $100, as it would now be expected to pay you $2.27 over the next 12 months. Thus, the current dividend yield is telling you how much in dividends you're expected to get over the next year as a percentage of how much you invest. Let's do the math with today's Coke price, and let's pretend you invested $10K into it. Thus, you'd expect to make about 2.93% of a $10,000, which equals $293 over the upcoming year, assuming no dividend changes. So $10,000 when it's at $69.71 a share means you'd buy about 143.45 shares of it, as brokerages let you own fractional shares of stock. Each share you'd own pays out $2.04 per year, so 143.45 shares times 204 per share per year equals about $293 in divvies, like we previously estimated. Coke actually pays quarterly, so it pays 51 cents per share every 3 months. That means your 143.45 shares will pay you about $73.16 every quarter. Coke's stock price could fall to $10 a share and you'd still get your $73 every 3 months. It could also shoot up to $100,000 a share and you'd still expect to get your $73 a quarter. Anyway, Coca-Cola, ticker KO, is the 17th largest ticker of the 28 tickers I own in my portfolio. I own 1,666 shares of it, which freaks my wife out when she sees all those sixes because she's superstitious, but those shares generate about $850 per quarter or just under $3,400 per year. Take a look at my Coke dividend income over the last 5 years I've been on YouTube. So in April of 2020, Coke paid me $665.31. Back then, Coke was paying out 41 cents per share per quarter, and I had 1,622.71 shares of it. The reason I had about 43 shares less than I do now is because at that time I was reinvesting my Coke dividends back into my Coke stock, so I was slowly buying more of it. I mean, back then I had my brokerage configured to automatically take that $665 quarterly dividend and buy more shares of Coke, and back then it was around $49 a share, and $665 divided by 49 equals 13.6 more shares, taking me from 1,622 shares to 1,636 shares. With my higher share total, it means my next payout would go up, even though the Coke company didn't do a dividend hike. So my next estimated quarterly Coke dividend would be 1,636 shares times 41 cents per share, which is about $671. And sure enough, in July of 2020, Coke paid me $671.61. All that happened automatically once things were set up, which is why people talk about how dividends pay you while you sleep. So in October, my DRIP bought more shares, taking me to a payout of $677. Then one for $683, and then they did a dividend hike, taking my next payout in April of 2021 to $699. That's when I turned off my DRIPs and I started using most of my dividends to pay bills. So again, I got $699 in July of 2021, and then again in October and December. And you might be noticing that Coke doesn't follow the classic 3-month payout pattern, though they still pay out 4 times a year. Then Coke did a dividend hike, so I got $733 in April of 2022. I stayed at $733 each quarter until they did their next dividend hike, taking me to $766 in April of 2023. It stayed there until they did their next dividend hike, taking me to $808 in April of 2024. It stayed at that amount until their next dividend hike, taking me to about $850 in April of this year. So in the time I've been on YouTube, Coke has paid me $17,275 in dividends. And over those 6 years, my total dividend portfolio has paid me almost $600,000 in dividends and distributions, almost all of which I've used to pay my family's bills. And I've slowly increased my share count and overall ownership percentage, on average, of my various tickers. I've not had to sell stock to get my cash back out, but that doesn't mean dividends are free money, and I recommend you watch a video I did on this subject to understand what I mean. I also advise that most people keep their dividend reinvestment flag on for as long as they can, even though it might be tempting to just use your passive cash. I mean, I reinvested my dividends for multiple decades, which is how my portfolio was able to compound so much to the point it's at today, where I'm making over $150,000 a year in passive dividend income. And ideally you have your dividends in a Roth retirement account, so you basically don't have to worry about tax issues, as dividends are often considered taxable income when they're paid out. That means that when you get dividends on stocks you hold in a taxable account, then you'll probably owe taxes on them, even if you reinvest them. And right there is one reason why some people say dividends don't work for them, because they don't like the idea of forced probable taxation. Qualified dividends tend to be more tax-friendly than wage income, but it's still often taxable. Now, distributions from master limited partnership tickers are different, and they may not count as taxable income, even in a taxable account. You see, a big part of what you receive from MLPs is considered a return of capital, which means it's not taxed right away, but instead reduces your cost basis in the investment until you eventually sell it. Like, I have an MLP called Enterprise Product Partners in my taxable account, and I basically don't own any income taxes on it for like the next 7 years, which is pretty awesome, as each 3 months I get paid $2,607 of tax-free income from them. You actually don't want to own an MLP in a retirement account due to some nuances with it, and a big takeaway is that you need to understand how different sorts of companies are taxed and what sorts of accounts you should put them in, and the implications of all that. Never just hit the buy button without doing your due diligence, and there are often ways to optimize your taxes if you research. For example, a married couple in the US can make $126,000 a year of qualified dividends in a taxable account and owe $0 in federal income taxes if that was their only income. So again, you gotta dive into the details to understand how things work, but merely saying dividends don't work or dividend investing doesn't work or whatever is kinda silly to me, and sounds like someone speaking from ignorance rather than insight. Or maybe they're just saying that to get people to click. Anyway, I much prefer getting dividend cash rather than having to sell my shares for cash. I mean, I've been in the spot where I needed to sell during a market crash, and it really sucks to do that. Moving on, some people argue that dividend investing doesn't really work because when a company pays a dividend, the stock price usually dips by about the same amount. So they understandably say, if the price just drops when the dividend is paid, how are you actually gaining anything from it? Now, first I should say that when a stock pays a dividend, its price doesn't usually drop by the full amount of that dividend. Research shows it averages somewhere around 80 to 90% of the dividend, and that pattern has actually been studied and is known as the ex-dividend date anomaly. But a key point I think the naysayers miss is that the stock price isn't usually the same as the true intrinsic value of the company, and when a dividend is paid and the price drops, that movement is often just noise rather than something meaningful. I mean, just because Coca-Cola pays a dividend doesn't mean their ability to keep selling Coke products goes down. Yes, it can mean they have a bit less to reinvest into other growth projects, but companies like Coca-Cola are already well established and often have limited new growth opportunities, so instead they do the sensible thing and return their extra cash to shareholders. And that's also another reason some people don't like dividends, because they believe that constantly putting every dollar back into growth is always the smarter move. But Buffett himself has talked about why companies shouldn't always reinvest every dollar into growth, and he's also explained why some companies are better off paying dividends. He's even said that someday in the future Berkshire will likely pay a dividend, though that day hasn't come yet. Anyway, when dividend naysayers claim that you can just sell shares to manufacture your own dividend, and that it's better because you can control when that happens, how much you get, and even manage the taxes, they usually leave out the fact that selling shares means giving up some or all of your ownership in that company, whereas with dividends you don't. That's why you can have retirees who live entirely on dividend income for decades without ever selling any shares, and in many cases their ownership percentage in those companies actually goes up, either because of share buybacks the company does, or because the retirees choose to reinvest a small portion of their dividend income. And speaking of buybacks, there are two main ways companies return cash to shareholders. Number one is a dividend, and number two is a share buyback. With a cash dividend, the company pays money directly to shareholders. With a share or stock repurchase, the company uses its cash to buy back its own shares from the market, which reduces the number of shares that exist. So stock buybacks are really just an indirect way for shareholders to get paid, because even though you don't receive cash in hand, your ownership percentage in the company increases. Bottom line, dividends have been around for literally hundreds of years, and many of the best businesses in history have made the decision to pay them. So are investors who focus on dividends really doing something that doesn't work? I mean, just this year we saw how Google started paying a dividend, Meta started paying one, and even Salesforce began paying one. There are plenty of reasons why companies decide to start paying dividends, and one of them is that it lets executives and founders generate liquidity without having to sell any of their shares. Dividends give them cash while still keeping their ownership stake intact, and it also avoids the negative optics that can come with insiders selling stock. Another reason companies often start paying a dividend is when they consistently generate large amounts of free cash flow that exceed what's needed for operations, research and development, or even major acquisitions, kind of like what Buffett talks about. In those cases, returning some of that cash to shareholders becomes an efficient and sensible use of the surplus. And another reality is that as a company matures and reaches market saturation, the returns on new internal projects often start to decline, which is when returning capital as dividends can actually be more financially responsible than pouring money into ventures with diminishing payoffs. Plus, for many investors, paying a dividend is a credible signal to the market that management expects strong and predictable earnings well into the future, which shows that the core business model is proven and reliable rather than speculative. On top of that, initiating a dividend often opens the stock to a much larger pool of capital from income-focused investors, including retirees, pension funds, and insurance companies that offer annuities, some of which are even required to invest only in dividend-paying stocks. So as a company's revenue growth naturally slows over time, the market's focus tends to shift from pure capital appreciation to total return, and dividends help a stock stay attractive even in slower growth environments. For example, take a look at this chart that shows dividend income as a percentage of the S&P 500's total returns. What you'll notice is that in decades when stock prices struggled, dividends made up a significant portion of the overall return. In fact, since 1900, dividends have accounted for roughly half of the S&P 500's total return, so thinking they don't matter or that dividend-focused investing doesn't work is pretty bizarre. And that kind of performance during down markets is one of the reasons why conservative investors value them so much, because dividend-paying stocks tend to be less volatile and usually hold up better when times get tough. So in good markets, they still perform just fine, and in bad markets, they tend to hold up better, which often gives investors a smoother, less hectic, and much less stressful ride over time. Anyway, I found that in general, the higher the dividend yield, the higher the risk tends to be, and often the lower the growth potential. It's not always true in every case, but it does seem to hold up pretty often. For example, companies like Costco or Microsoft usually have lower dividend yields, but they also tend to deliver stronger stock appreciation over time. Utilities and energy companies usually have higher dividend yields and larger payouts relative to what you invest, but they also tend to have less stock appreciation potential. The key is to make sure that whatever you invest in actually has sustainable cash flow and at least some room for growth, because you don't want to chase a high yield from a company that ends up cutting its dividend or going under when the market turns. Often a high yield also means higher risk, maybe because the company's in an industry that's slowly declining, like traditional tobacco products, or because they're using complex financial strategies that come with their own risks that can limit your upside. You really need to be careful when you see yields promising 10% or more, because that kind of return has been almost impossible to sustain over the long run, at least historically speaking. Moving on, there are other reasons companies pay dividends, and when they use them alongside buybacks, it gives shareholders a steadier and more predictable stream of income instead of relying completely on the indirect effect of share price appreciation from buybacks. We've seen plenty of companies that were buying back shares right before going bankrupt, or that spent huge sums on buybacks only to see their stock price fall, leaving shareholders worse off. At least with dividends, investors receive real cash returns in the present instead of just hoping the market will value the stock higher at some time in the future. Plus, I think when a company starts paying a dividend, it puts pressure on their competitors to follow suit to avoid signaling a lack of financial strength or lower commitment to returning capital to shareholders. I also think paying dividends creates a kind of financial discipline for management teams because it discourages them from chasing wasteful or low-return projects. I mean, knowing they have to keep paying that dividend or risk frustrating a lot of shareholders adds some healthy pressure that I see as positive. Of course, dividends are supposed to come from real profits, and if a company's borrowing money just to keep paying them, that's obviously not a sustainable long-term source of income. And one thing I always like to tell folks is that generally speaking, the best bet, at least historically speaking, has been for most investors to simply go with a broad market ETF like VU, which also pays divvies. So while dividends aren't magic, investing in them often works, depending on your goals and needs, but they also have their risks. The most common trap is chasing high yield instead of quality, and investors who do that often get burned over the long run. Many of those high-yield stocks end up underperforming over time, especially during strong tech bull markets like the one we've been in. But in some cases, dividend investors are fine with that trade-off because they often see less downside in bad markets and find more peace of mind knowing that they don't have to sell shares to create income. And for me, time is my most valuable asset, and the truly passive nature of income flowing in without me having to do anything in the markets for it is hard to overstate. And yet some people say that it's exactly because of all that dividend investing doesn't make sense, because to them the only thing that should matter is total return. But the reality is that not everyone thinks that way. Some people prefer bonds or CDs or real estate or even crypto, and each one comes with its own pros, cons, and risks. Each asset can either help or hurt your financial goals in different ways, so it doesn't make sense to look down on someone who values true passive income more than just total returns. I mean, why even invest in stocks at all if Bitcoin has outperformed them since inception? Maybe the answer is that everyone has their own risk tolerance, beliefs, and comfort levels, and the best strategy is one that truly fits your goals and how you want to live your life. Remember that when it comes to investing, one person's trash is another person's treasure. Think of Warren Buffett, who called Bitcoin rat poison. He said that putting money into it is gambling, not investing, and he even predicted with almost certainty that cryptocurrencies would come to a bad end, though he admitted he didn't know when or how. The key point in me sharing that anecdote is that when it comes to investing, almost every strategy has both fans and critics. Some people swear by dividends, others say they're useless. Some see Bitcoin as a revolution, while others think it's worthless. The reason for all this disagreement really comes down to something simple but powerful, which is individual utility, meaning that what is valuable to one person might be worthless to another. Anyway, one thing dividend naysayers often overlook is total returns over history. The truth is that over the long run, dividend-paying stocks have outperformed non-dividend stocks on average, as this historical data shows. So when someone says dividend investing does not work, it often means that they're either unaware of the long-term performance of stocks, or more likely, they're using an attention-grabbing title to get clicks, even though they might know that dividend stocks have tended to outperform. This particular analysis looked at 50 years of stock performance from 1973 to 2024 and found that companies which paid and grew their dividends had the best total returns, far better than companies that did not pay dividends. That doesn't mean that every dividend-paying company is great, or that non-dividend-paying companies are bad investments, but it does reveal clear long-term trends that show dividend investing can absolutely work, especially if you avoid obvious mistakes. That all being said, tech stocks are having an incredible run right now. many with tiny dividends, so invest in a way that makes sense to you. And remember that about 80% of the S&P 500 pays dividends, so the question really becomes, if dividends do not matter, then why do almost all of the biggest and best companies in the world pay them? In the end, there are an infinite number of ways to invest, and I honestly don't care what you decide to do, but I do hope you live within a budget and invest and continue becoming more financially literate. And one thing we should recognize is that even disciplined investors can struggle when emotions take over. They FOMO in and out of positions, they hold back because the markets feel too high or too low, and then they let short-term emotions drive long-term decisions. When markets drop, fear and uncertainty take over, and people start focusing on their losses instead of their investing strategies. That's when loss aversion takes center stage, where investors feel the pain of losing money much more strongly than the pleasure of gaining it. During big sell-offs, panic and herd behavior can push people to sell at the worst possible time, locking in losses and missing the recovery that often follows. And that kind of emotional decision-making is what causes many people to give up investing altogether, and I've seen it happen more than once. But focusing on blue-chip dividend stocks can help counter that tendency. I mean, large, well-established companies tend to be more stable, which gives investors a smoother ride and makes it easier to stay calm during market turbulence. On top of that, the regular dividend payments create a feeling of progress and reward even when prices are down, and having that steady income coming in helps investors stay focused on the bigger picture and stick with their plan over time. So does dividend investing work? Well, it depends if you do it intelligently. If you invest in bad companies, if you don't live within a budget, and if you never take time to understand account types, taxes, and all that stuff, then no, dividend investing will not work for you. No amount of money can fix poor decisions. I recently saw an article about Allen Iverson, the famous NBA player, who has a net worth of around $1 million today. That might sound good, but he earned about $155 million from his NBA salaries over his career, plus more than $60 million from endorsements and merchandise deals. So if your cash keeps slipping through your fingers because you're not managing it, you'll eventually end up in a rough spot. But don't feel bad for Iverson, because he signed a lifetime deal with Reebok that pays him around $800,000 a year, and in 2030 he'll get a payout of about $32 million. I share that story not to make fun of a mega athlete who lost tons of money, but to show you that you need to become financially literate to increase the odds of your long-term success. If you can invest intelligently and live within a budget, you'll probably be fine. Whether that's stocks, real estate, crypto, or whatever, there are countless ways to make money and just as many ways to lose it. TLDR, investment itself is not necessarily good or bad, but its value depends on what you need it to do for you. And that leads to the bigger truth, which is that the outcome matters more than anyone's opinion. I mean, if your investment helped you buy a home, start a business, or retire earlier, then it probably worked for you. It doesn't matter if someone on YouTube or even Warren Buffett thinks it's a bad idea. Everyone is playing a different game with different goals, timelines, and comfort levels. The only thing that counts is whether your decisions move you closer to your goals. Investing isn't about finding universal approval. It's about finding what fits your life, your psychology, and your plan, and then sticking with it long enough for the results to speak louder than the critics. For me, dividend investing works, but I can understand why it doesn't work for everyone. My hope is that you find the right assets and the right approach that helps strengthen your long-term financial future, because not enough people ever do that. Like I recently read an article that said the number of homeless seniors had been rising sharply across the country. Last year, more than 42,000 people in the United States over the age of 65 were homeless, according to the Department of Housing and Urban Development. They call it the gray wave, and it's being driven by inflation, rising rents, and a lack of affordable housing. And those numbers are expected to get worse in the years ahead. That's why you have to do whatever you can right now to live within a budget and invest in solid, sustainable assets. I know life can be tough and money can be tight, but don't give up. Keep learning, keep pushing forward, and keep building toward a better future. I just saw a tweet about a well-known investor who went through a really tough life but never quit and ended up becoming incredibly successful. I mean, when he was in his 30s, his wife divorced him and she got the house. He went bankrupt. He lost an eye, and his 9-year-old son died of leukemia. He lived in a small apartment and drove an old beat-up car. Leave me a comment if you know who I'm talking about before I say it. That man was Charlie Munger, the billionaire friend and longtime business partner of Warren Buffett. My point in bringing it up is that everyone goes through hard times, and if you're struggling right now, then I truly feel for you. But don't let that keep you down. Everyone takes hits in life, some far worse than others, but no matter how deep the hole feels, you can climb your way out. Just don't give up. Don't let hardship define your life. Get your finances under control, live below your means, and invest intelligently for the rest of your life. Now let's wrap things up with the clip I mentioned earlier. This segment aired recently on Bloomberg Television and shows why even respectable financial media often falls into the trap of sensationalism. Sometimes YouTube won't allow you to show someone else's clip, so I'll list the URL of the video in the description of this video if it doesn't play for you right now.
Retail traders have a new obsession. It's not crypto or meme stocks, it's dividends. The promise is big. Put your money into one of the many new dividend-chasing ETFs that advertise yields higher than 50%, and you can get payouts that will allow you to escape the 9-to-5 hustle. But beneath the eye-catching payouts, investors are hit by smaller returns and big tax bills. The craze has sparked a network of YouTube channels, Discord servers, subreddits, and influencers promoting the latest hot retail trends.
Basically, right in the middle of that segment that's complaining about the craze for income, they flash an image of my Dividend Discord server, and the clip is basically about influencers promoting ETFs yielding 50% and 90%. This is the core of their sensationalism. But clearly my channel and brand aren't promoting a get-rich-quick scheme with promises of 50% plus dividend yield payouts. To me, it looks like they're generalizing the entire dividend investing space based on the riskiest, most speculative fringe products, and if they'd done their research, they would have known that I promote quality company investing, and I'm a fairly conservative investor. I mean, the vast majority of my capital is focused on quality, traditional dividend growth stocks, companies that are pretty safe, reliable, and provide long-term capital appreciation. That's the engine of my portfolio, which has a fairly conservative average weighted yield of 4.2% in retirement. In fact, about half of my tickers are under a 3% yield, including a top 5 position of mine in Microsoft at its less than 1% yield. I've also shown how my higher yielding covered call ETFs are only around 15% of my portfolio, and even then the average weighted yield of those ETFs is only at 7.7%. That is miles away from the 50% or 90% hysteria they talked about. Now sure, there are some influencers who go all in on super high yield stuff, but that's clearly not me. I've explained the risks in high-yielding ETFs, and I constantly promote that young people's best bet is to invest in inexpensive broad market ETFs like FU. Plus, I've repeatedly explained ways how you can optimize your dividend taxes by using qualified dividends and MLPs and taxable accounts, and ways you can make over $100K a year as a married couple and no $0 in federal income taxes, none of which is the advice of a reckless yield chaser. I also have multiple tax channels on my Discord where people talk about taxes both in the US and beyond. To be fair, they do correctly mention that many high-yield payouts don't get the preferential tax treatment of qualified dividends, which is true for most covered call ETF distributions, and that's part of the reason why I hold my CC ETFs in tax-advantaged accounts. So while Bloomberg's warning about reckless yield chasing is correct, by lumping in communities like mine that tend to foster safer, risk-managed income, they missed the critical difference and inaccurately portrayed my brand. The reality is that you can incorporate strategic income into a conservative portfolio, but it requires discipline, smaller allocations, and a focus on quality first, at least in my humble opinion. Bloomberg actually reached out to me a few months ago and asked if I could speak to them about dividend investing and the growing communities that have been formed. I told them I'd be open to chatting on my Dividend Discord server, depending on what they had in mind. They said last year they wrote a story about investors looking for yield via ETFs, and they shared a link. And they said now they're looking to do a similar story, but with a focus on dividends in particular and why investors are drawn to them. I couldn't read the link they shared because it required you pay for Bloomberg access, so I asked for a non-paywalled link, and I said I'd be open to chatting on my Discord either by voice or typing. They never responded back after that. So leave me a comment and tell me what you think about all of it. Are my thoughts reasonable? Or are you thinking something like this?
What you just said is one of the most insanely idiotic things I have ever heard. At no point in your rambling, incoherent response were you even close to anything that could be considered a rational thought. Everyone in this room is now dumber for having listened to it.
Whatever you think, I recommend you join my free Dividend Discord chat server and see for yourself what you think about my investing community. And with that, I ask you to please do me another favor and hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Moving on, now I'd like to show my gratitude to subscribers who left me kind comments, so I'm going to shout out 10 who've done just that. So thank yous go out to Sebastian Pullman, Dumpster Fire, Have Chopsticks Will Travel, Kathy Wyckoff, SCHD Stan, Trance King PJ, Joe from Somewhere, multiple from Blue Collar Bullion Baller, multiple from Investing with Adam K, and multiple from Major Sam. Thanks folks, I really appreciate it. Now I'd like to recommend you check out my Seeking Alpha affiliate link, which often has a discount when new users sign up. I'd also like to pitch my Fast Graphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment even if they sign up for a full year. Also check out my Patreon page, and or consider joining my channel membership, as both have some cool perks you might like. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.